Can I get the icon in cornflower blue?
Hey everybody, welcome to episode 18 of Can I Get That Software in Blue? I'm one of your hosts, Chad Tindel, and along with me is my co-host. He hails from Arizona, loves the cars at Daytona. His favorite song? My Sharona. The MVP of VPs, the Sultana of Grafana, Steve Mayzak. Thanks for joining me.
Oh, thanks for having me, Chad. Your intros get better and better. I appreciate it.
Well, we are getting some good feedback from the show that we had with Mike. People are liking that we brought some perspective from the customer side, you know, people who are buying instead of just selling stuff, which is what we focused on. So that's nice to hear.
Yeah, that's great. And also, this is our 18th episode. So, like, we're getting kicked out of the house now. Like, we're about to become an adult. It's kind of nice.
We're growing up.
We made it this far. Yeah,
we're growing up. All right. Well, we have a special guest today. He is extraordinarily well credentialed. He has an electrical engineering degree from Princeton and then an MBA from Harvard Business School. And I know that sometimes people in the tech world like to knock on MBAs, but honestly, I think it's a valuable education. I don't think it's ruining the tech industry or anything like that. I think there's a lot of value in understanding the business side, understanding accounting, and how can you do what you do if you can't look at accounting statements and understand whether they're honest and true. And so I think there's a strong value there, and that's not an easy school to get into. So he's definitely got some chops. He was vice president of product at Splunk and Elastic after that, both very successful companies. Now he's a general partner at Lightspeed Venture Partners, which he's going to tell us a lot more about on the show here in a bit. He's led a number of high-profile Series A and B rounds, as well as numerous seed rounds. He wins founders' hearts with SaaS knowledge that's off the charts. The GP who makes VC look easy. Gaurav Gupta, welcome to the show.
Thank you, guys. Excited to be here.
We are excited to have you. We've been talking about this episode since you agreed to do it. So
our first VC episode, talk about growing up.
Exactly.
I'll add that going to business school made me realize I like tech more than business, which is why I did product right afterwards.
It makes sense. It totally makes sense.
That's funny. So just for the listener, like Gaurav, Chad, and I all met at Elastic. So Gaurav was VP of product there. And I don't know why, but I'm grateful that he kind of took me under his wing and helped me think through some stuff and grow as a leader. So I was very fortunate to have Gaurav as a mentor there. You know, obviously we have a relationship, and it's maybe not a coincidence that I'm now at Grafana, which is one of the companies that Gaurav invested in after he became a VC. So that's kind of our background together.
Yeah, he really helped Elastic grow from just kind of a niche full text search engine into something that handles logs and metrics and really the full observability stack and security stack that they're handling now. So that's quite a transition he led them through product-wise.
Yeah, for sure. So Gaurav, I thought maybe we start with like your journey to Lightspeed, and then we talk about Lightspeed, because I think most of the content we want to talk about is what it's like to be a VC. But for the folks that are listening, and for us too, like what is it that you think in your path to becoming a VC was like the most helpful? Was it your MBA? Was it your experience as a leader of product? Was it kind of a combination of these things?
Gosh, I feel like it starts from when I was a kid.
Okay.
You know, when I was like 9 or 10 years old, I was just always super curious of like how technology worked.
We're going way back here.
And like, you know, was running a BBS and, you know, dialing into various things, and like just super fascinated by it.
Okay, hold on. I gotta stop you. What kind of BBS software did you run? Because I ran a Renegade bulletin board for a long time.
I'm trying to remember. I don't even remember. It was a short-lived BBS that I actually ran. I was mostly using other people's.
Yeah. Okay.
But the thing about it is I think it was in college I studied electrical engineering and computer science, and so I was asking myself, okay, great, I now kind of understand how this stuff works. But why is it that sometimes some technologies are more successful than others, even though one seems to be better technically, the other is more commercially successful? And, you know, I was always fascinated with like Bill Gates and you know, Apple and sort of the battle that was going on there as well. And so that really got me. I mean, that curiosity is what got me into venture capital eventually, because it's really that perfect intersection between the tech and the business, and why are things successful? Why did they take off?
Yeah.
So when I was in college, I became interested in that intersection. I was like, well, how do I find a job at that intersection? And I'd read this book, Crossing the Chasm, by Jeffrey Moore, which is a classic. Everybody should read it if you haven't. I feel like the younger generation these days doesn't read it, and I always recommend it. And there's a guy named Regis McKenna who wrote the foreword to the book. and Jeffrey Moore used to work at his consulting firm. And so I cold emailed them. And I don't think they'd ever hired an undergrad, and it said, hey, I don't really want to work at McKinsey or BCG or something like that. I want to work in tech, and got a job there. It was the year 2000. And I joined. And so we specialized in high tech growth strategies for tech companies and startups. And you join in year 2000 and none of these companies are really growing anymore. Actually, you're trying to figure out what to do with them. And so we were actually hired, we were hired by big tech companies like IBM. We were also hired by VCs who in mid 2000 were trying to figure out how to turn around their startups that didn't have product market fit. And so we do customer calls and do all this other stuff. So I'd say, yeah, it was actually pretty. My first interaction with VCs was sort of in that 2000 timeframe, where they were trying to figure out how do we turn these companies around. And it's sort of funny that we're now talking now, right? Because a lot of people compare where we are today as potentially being like 2000.
That's fascinating. So you got in before the bubble burst. What was it like when that thing burst and everyone just started crashing down? Like, I'm sure there's some memorable experiences from that period.
Yeah, I was a kid, right? I was like right out of college, so I don't know if I fully knew what was going on. I just remember thinking, wow, like tech's really tough. Like selling software is really hard. Like nobody uses this stuff, right? Because I was mostly dealing with problem childs, right?
Do you agree with people who say that now is like the 2000 crash, or what's your view on that?
I think there's probably there are definitely some elements of it, right? Because really with 2000, like you just had a set of companies that were completely overhyped. The expectations around them had no relation to the actual underlying business. And I think it doesn't feel as bad now, but 2021 and the funding market and the expectations around some of these companies just didn't make any sense. So now things are sort of correcting, right? And so I do think it's different from, it's probably more like 2000 than it is 2008, where it was specific aspects of a financial crisis that affected 2008.
So Gaurav, it seems like we had this .com crash 2 decades ago, and then here we are having something similar. Is it because like there's just like not the information knowledge transfer from one generation to the next, and next thing you know, like all these new VCs start investing in things because it's a hot market and they don't want to miss out, and then they stop doing due diligence, and next thing you know, here we are? Like, is that part of how we get into these situations, you think?
I think there's ups and downs sort of naturally in the market. There were lots of reasons to be excited for the last 5 years about technology, like especially infrastructure in the area that you all and I play in, like fundamental drivers of like the world has more data, everything's becoming an application, and then you just had everybody realize you could make a lot of money, and you had a lot of capital inflow. And so I just think like as you get more and more people who have maybe not seen the prior movie, right? People get excited, and then oftentimes people who have seen the prior movie sort of realize they'll miss out if they don't participate, right? And so they know that the market's inflated, but they also don't know like what's the new normal, because the new normal also changes from year to year. So it's I'm guilty of it too. I feel like I've gone through 2000, 2008, but those were a long time ago. So I sort of forgot the new normal as well.
Yeah, that's fair. I remember as a developer back during the .com boom, like looking around, and I was brand new in the industry. I'm like looking around like, this can't last forever. Like people were doing dumb things, and I was just a dumb kid, and I was like, this doesn't make any sense. And then, I'd go work on a 6-month project. We'd build this massive application and invest millions of dollars so that people could find a trail near their house. I was like, this maybe doesn't make any sense. Like, and we built it all in Cold Fusion, which is even more hilarious. But like this can't last forever. So when the .com burst happened, the bubble burst, I was like, okay. So my gut told me that it couldn't last forever, and it didn't last forever. And so over the last couple of decades, I think I'm honing that a little bit better. And I started to get that feeling like late last year, maybe mid last year, like hearing about companies that are getting funding that don't have any revenue. It's like, okay, I get it, but nowadays when you can kind of start your own company with a credit card, it seems like that's a bit more risky. And I just saw new venture capital money going into new companies that you'd never heard of. It was like getting very frothy, so to speak. So Gaurav, how did you get into leading product groups? Like, why was that kind of, it seems like that's where you found one of your grooves, like leading product for Splunk and then Elastic. Like what led you there, and why did you love that role?
Yeah. So I'll just like continue my history just a little bit because I'll tell the story. So after McKenna, actually, the consulting firm ended up shutting down in late 2002 because the market.
Yeah.
So my first job didn't work out terribly well after college. And I joined the PC company called Gateway.
Oh yeah,
old
the
timers
didn't they have a
probably heard
cow logo or something?
And I was living in
Yeah.
Boston, and Gateway is based in San Diego, and so I flew over there for the interview. I was like, "Wow, this place is amazing!" And so I joined a turnaround strategy team. The company wasn't doing very well. Spent a year and a half there. It's the first time I was exposed to product management, and sort of realized that product differentiation is important. And Gateway really wasn't. And let's say that company ended up getting acquired and merging with another, and eventually left, and then moved back to the East Coast and worked for a VC firm for 2 years as sort of an analyst associate. This is the 2004 to 6 timeframe. And, interestingly enough, we were dealing with a lot of the aftermath of the dot-com bubble. There were a lot of flat rounds and down rounds and anti-dilution terms and all this other stuff happening back in the day. And I was really helping a bunch of other folks, do deals. I wasn't leading deals. It was a lot of fun, but I quickly realized I wanted to be on the other side of the table. Honestly, I felt a little bit like a fraud. Being a VC at that point in time, I was like sitting in a board meeting, observing, and I'm like, I have nothing to say. And even if I said something, I'm not really sure whether it would be right because I hadn't really built anything. I kind of created PowerPoint slides most of my career. I ended up looking for a product management job, not being able to find anything, and kind of as a backup, applied to business school. And, got in, and, after, while I was at business school, I sort of had decided in my head, like, I was going to try to do product management. And I was going to finally move out to the Silicon Valley. So after graduating, moved out to the Bay Area and just kind of hustled my way to this job at Splunk, which, I'd always loved data. I knew that enterprise software was where I wanted to be. And when I walked in the door for the first couple of interviews, I was just blown away by the founders and how much fun it was. And it was probably one of the only enterprise software products in that time also that you could download and use.
Yeah.
And so I was able, even though I had no background in like IT and sysadmin and logging, I actually took the product. Back in the day, you used a lot of different chat programs like, AOL Instant Messenger and ICQ and all these things. Yeah. So I had a universal chat client on my laptop. And so I took the logs from it and I put them into Splunk, the free version. And I made did some queries and a bunch of stuff. And so I went into my interview and said, hey, I did all this stuff with your product. I have some feedback. And so, that's how I convinced them. That's how I convinced them to give me a job.
Right on. So
that's a good technique. That's a good technique. I feel like everybody should be doing that before they go on an interview somewhere. Come with product feedback.
Totally. Here's how you can make it better.
Yeah.
So you went from product manager all the way to leading that organization in, I think, 5 years or so. And then you decided to leave and join Elastic. Like, what was your thinking there? Like, why leave Splunk when they're, clearly successful and still remain so? What drew you to Elastic? And then we can talk about Lightspeed after that.
Yeah. So at Splunk, I was on the core enterprise product, which is like, it's the favorite product I've ever worked on. I mean, it's near and dear to my heart. It's an amazing thing. And then my last couple of years there, I led a team to start our first cloud product. And, I'll say it was not the easiest journey. We were sort of a skunkworks team, and we were a on-prem company migrating to the cloud. And I think we all know that story. And so about 5.5 years, I admittedly got a little frustrated. I was also getting a little bit bored. The company was becoming big.
Yeah.
I'd like to say I kind of expire out of companies as they grow to be 1,000 people plus.
Yeah.
And I left, and actually, with the intention of sort of figuring out what would take some time off and figure out what makes me happy. And I thought it was probably going to be starting a company. I was working on a bunch of ideas, trying to meet co-founders, and I ended up working on this idea that involved doing source code search, taking all the source code from GitHub and other places as part of kind of brainstorming a product and building a product in that area. Started using a ton of open source and completely fell in love with open source. Actually Elastic happened almost a full year after I left Splunk, right? So it took this long journey. A lot of people think I just left Splunk and joined the competitor Elastic. It's not true at all. In fact, when I left Splunk, someone had asked me okay, what do you want to do, Gaurav? I think it was some VC. And I think I told them, I told them something to the effect of well, the one thing I know I don't want to do is logs. I'm tired of logs. I've been doing logs for 5.5 years at Splunk. I probably don't want to do something in the same space. I want to do something new. And of course, that's life, right? What you think you want changes over time. And so, so a year later, I ended up at Elastic.
Doing logs.
Doing logs.
Well, I'm glad you did, Gaurav. You would not have met had it not been for that. So you leave Elastic, and what happens after? Is it the same type of thing where you're okay, I got to figure out what I want to do next?
Yeah. So 4 years Elastic. Yeah. Then the same thing. Hey, maybe I should start a company. Maybe what? Let me figure out what I want to do. Well, I was at Elastic, but also shortly after I left, I was approached by a bunch of VCs that said, "Hey, you picked 2 companies that were pretty successful. Maybe you're good at this thing." And I'm like, "Well, it's 2 data points, and there was definitely a lot of luck involved there." During my time off, again, never really found something I was passionate enough to start. Yeah. But I was doing a bunch of angel investing and advising, maybe a dozen companies, and really loved it. But at the same time, felt how do I do this in a more meaningful way? Yeah. How do I go deeper with these companies more than just a conversation or two? You guys have been advisors before. That can be frustrating sometimes.
That's right. You get a snapshot every couple of weeks.
Yeah. It's almost like venture's my vehicle to be, get deeper with these companies, but be part of multiple companies at the same time.
Can you give us a tight 3 minutes on what Lightspeed's areas of focus are and kind of some of the big investments that they've done and also the investments that you've led since coming there? Give us an overview there.
Yeah, totally. Lightspeed, it was founded in 2000 and originally started focused on early stage enterprise. And so it's actually really well known in, enterprise software, infrastructure, SaaS applications. But since then has basically expanded to everything. We're now in the US, Europe, Israel, India, China. We do early stage, we do growth stage, we do enterprise, we do consumer, we do healthcare, fintech. But I personally focus on where the firm originally started, which is that early stage enterprise domain. From a stage perspective, we invest across stages, so we will be the first check, writing a couple $1 million in a seed round, all the way to hundreds of millions of dollars in sort of pre-IPO rounds. At this point, there's almost nothing that we don't do. I tend to focus on infrastructure, and I think we're well known for it as a firm. We were early investors in companies like Informatica and Riverbed back in the day, storage companies. And of course, since then, that's changed to be more of cloud and data companies. And so we were early investors in AppDynamics, and we're in Rubrik and ThoughtSpot, a variety of companies that sort of power sort of modern applications and data and cloud. Personally, my first investment was the company you work at, Steve, Grafana. Led the Series A and also the Series B in that company. It's near and dear to my heart. I feel like it's so related to my background at Elastic and Splunk. I'm probably the perfect investor for them. I've also invested in a company called Panther, which is, you can think of it as the next-gen SIEM, SIEM, Security Information Event Management Platform, but it's really much more than that. Panther leverages cloud data warehouse storage underneath, things like Snowflake and and S3, but also the entire infrastructure is built using serverless technology like AWS Lambda. It really kind of disrupts that security analytics market with a new architecture. They're led to Series A. Also invested in a company called Hasura, which is a sort of, you can think of it as infrastructure that powers data-driven apps and really focuses on making it easy for developers to use kind of a new API technology called GraphQL that was developed at Facebook. And also recently invested in a company called Clickhouse, which is a next-gen OLAP database technology that's also open source. So those are just some examples of companies I've invested in since joining.
Yeah, and so let's talk about Clickhouse for a minute, because we're familiar with the CEO of Clickhouse. We all worked with him at Elastic, Aaron, and they went through a couple rounds of financing in short succession. Really, they did an A and a B, I think, pretty close to each other, right?
Yeah.
What was driving that decision to do the B so quickly after the A in their case?
Yeah, I mean, I can't speak for everything, all the reasons, since I ended up investing in the B myself, although I've been talking to Aaron and tracking the company from the very earliest days.
It was just such an uncharacteristically short period of time, I feel like. So I was just really curious about that one in particular.
Yeah. It was unusual. I don't think that was the plan originally. The plan was to raise the A, and the A really represented also the spin out of the technology, right? Which was built at Yandex, and they spun it out into an independent U.S. company just to make everything super clean, which in retrospect was a very smart decision.
Of course, yeah. Russian founders, yeah.
No employees are there anymore in Russia, and it's very clean. They did it right. I think what happened is the adoption of Clickhouse is it's a very rare situation that you see a database technology that's been under development for 13 or 14 years that doesn't have a company behind it.
Right. Just a pure open source project.
That's a hardened database technology. Investors are very wary of investing in database companies because they take 10 years to build, right, and harden. And so here was an opportunity to invest in a database company where the technology had been tested at scale. Very unique opportunity. And so wasn't necessarily driven by me, but there was a set of investors who got very excited about that. And when they didn't get to participate in the A, they said, you know what, we'll just do the next round right now.
Wow.
And I think the company also saw an opportunity to disrupt some major vendors. I think Snowflake was probably at its peak at that point.
Sure.
And you can think there's a lot of analogies between Clickhouse and Snowflake. And so if you see the opportunity to build, at the time it was probably $70 or $80 billion market cap, right? Then, as an investor, you say, well, if this is a potential rival or a potential replacement for that down the line, I'm willing to pay a high price just to get in and be part of it.
Yeah, that's true. There aren't very many successful open source projects with massive adoption after 10 years that don't have some sort of company. That's a really good point.
It's one of a kind of opportunity. Yeah.
Yeah, not all open source projects would actually justify creating a company. Like, you just don't need it around some of them. You could argue, I wonder what would happen if Log4j had an actual company around it when all the Log4j stuff happened. Who knows?
Yeah. Clickhouse didn't have a company around it for a long time. And although there were companies trying to support and monetize Clickhouse, but I think it's really hard if you don't have some control over the open source and the roadmap and have all the core contributors. So that's why it was a very special situation to be able to sort of extract all these people out, right, into something independent.
Can you explain to people what's involved in becoming a partner of a fund? Is it just that they're out looking for people like you who have a lot of knowledge and connections in the space, and they just hire you and bring you on and that's your job? Or is it like, no, you have to come in and you have to like almost buy in as a partner and provide a bunch of capital into the fund yourself? Or like, what is that transition like?
Yeah. So my interview cycle with Lightspeed was probably like 10 years long in some ways. I think even in business school, one of the partners from Lightspeed reached out to me and said, hey, are you interested, or can we get to know each other? I'd been basically talking to different partners at the firm several times a year for almost 10 years in a variety of capacities. And so it's really a relationship business. There's a lot of trust that gets built. And so these things happen over a long-term period of time. And so when they sort of realized that I wanted to be a VC again, right? After I had sort of been turned off, maybe not turned off, but I didn't feel like I was ready, that first go around. That's when, a lot of those conversations over the years, finally helped in sort of making them confident that I could be a good VC and vice versa. It was a place that I wanted to work at. But, over those years, I helped, the VCs at Lightspeed and other places with diligence, evaluating companies. They oftentimes try to recruit me for their portfolio companies. And so, all of those ways are ways that you interact with a VC firm that help build that trust. And then for me, because I'd been an angel investor and advisor, and I knew the firm really well, I was brought in as sort of a partner that can kind of write checks out of the gate and sort of lead deals and sit on boards, partly because I also, had a bunch of operating experience. But for younger VCs that come in, typically they're assisting with deals in the beginning, right? And they're helping with the diligence and sort of the mechanics of the process, learning along the way. So there are different models to sort of becoming a partner at a VC firm.
But so when you do it, do you have to buy into it? Like contribute capital, or is that's typical or?
Yeah. So the venture firm raises money from limited partners, which are like, pension funds and endowments. And, there's a little bit of like, you have to have skin in the game. This isn't just other people's money. And so as part of that, partners are asked to put a percentage of an overall fund themselves into the fund. And so, yes, when you come on board, you might not really make any money your first year, right? Because your salary sort of pays for what they call the GP commit.
And what is that?
The general partner commitment to the fund.
Oh, okay. So your salary just goes right back into your fund, basically.
Oftentimes.
Okay.
Oftentimes. Yeah.
Gaurav, do you worry that I guess, how do you attract new talent that hasn't had the successes that all the other partners have had to buy into the firm? Like, do they start out, quote unquote, at the bottom and work their way up, like doing due diligence and things like that?
Various venture firms have different structures. Some have more hierarchy, some are more flat. But depending on your stage in your career, you may not have the money to actually invest in these funds. And so you can get loans, or other partners will cover your commitment. If you're earlier in your career, right, and there's no one path to being in venture, you can have an operating career like me, or you could be, someone who's coming out of a consulting firm, right? Or coming out of a couple of years of product management. If I meet a company, I would invite those folks along. They would listen to the pitch. They would help do the customer diligence. They would be helping the company. And sort of, even at my stage, the business is an apprenticeship business. Every VC tries to learn from their partners. And over time, they pick up things that help develop their own unique model to being a great investor, because every person has a little bit of a different style.
Yeah. Well, that's a good transition into how you find companies to invest in. Like, do they just show up at your door because so many people have a PowerPoint and a smile and ask for $2 million? Or do you have to go out and find these companies to invest in? Like, how does that work?
It's a mixture. For me, specifically, and I'll answer that, I try to develop some theses on like areas that I think are going to be growth areas in enterprise software by talking to people like you guys. So like, what are you seeing on the ground? What's exciting? And I'll go and like go online and research and like hunt down which are the interesting startups. I'll be talking to my network, be on LinkedIn and like literally like, going to conferences and trying to find these people and get in touch with them and asking for introductions. Okay. So that's the very proactive way of doing it. And oftentimes people will like couple that with social media or authoring content pieces to sort of get the word out that they're interested in those areas. The other way, which is a lot easier, which is what I prefer, is when they do sort of come to you. And, that happens in a number of ways. Like oftentimes, like someone will be thinking of starting a company and they'll ask someone they worked with, right? Or another founder of a company, like, what do I do next? And that founder will be like, well, I know so-and-so, or you should talk to these 10 or 15 firms that are really good at enterprise infrastructure. And they'll try to find the name of someone. So in my case, like probably what happens is that people say, okay, we want to talk to a top 10 enterprise infrastructure VC firm, and we want to talk to the person who knows data and open source the best. And someone's going to be like, oh, there's that guy Gaurav. He worked at Splunk and Elastic, and he invested in Grafana, all these open source companies. You should talk to him. And then, through you or through someone else I know, I'll get an email saying, hey, so-and-so would like to meet you. So-and-so would like to talk to you. And so there's, the warm intro is a very, very important thing in the venture capital business.
So if someone makes an intro between you and a founder, do they get like a little finder's fee, or how does that work? Do they get to wet their beak at all?
Not really.
They don't get points on the package. Nothing like that.
I'm very, very nice to people who send me, who send me like interesting information on companies, and try to always pay it back. I feel like this business is a lot of favors being done selflessly in the beginning for each other, and then it all comes around. So yeah. But there's no kickback system or anything like that. Honestly, I think that creates bad incentives. The best referrals are like ones where it's authentic, where it's like, I really like this person. They're a really good founder. Like, you should really talk to him, Gaurav. I'll definitely take that meeting, right? Because I trust you as well.
Yeah, that's interesting. I mean, I hear some podcasts of people who kind of tried to roll their podcast fame into starting a syndicate or, this type of angel list type of setup. And they'll say like, if you give me a lead, I'll give you like a certain amount of the carry or something like that. And I just didn't know if that was normal or that was abnormal or typical or atypical.
I've not really heard of that.
Your way makes more sense. I mean, that's what I would have expected.
Yeah, I think it's just, it's more authentic, it's more honest, it's more transparent for founders as well.
Gaurav, when you meet founders, like, I imagine it's kind of like an interview on both sides. You're trying to get to know each other, and you're probably looking for certain characteristics to determine if they have the it factor, right? Like, what do you look for in a founder?
Yeah. So I'll speak for myself. Like I said, every partner at Lightspeed has a different lens, and we debate and talk about this all the time. Okay. So for me, a lot of it matches up to what I looked for when I joined Splunk and Elastic. So, I'm looking for one, I always center in on the technical founder, or, a founder with a technical background who's experienced a problem in their past so deeply and thought about it so much that they've developed a unique way of thinking about how to solve it, right? Or a unique perspective. And so, to me, that's the most important thing, right? And ultimately, these companies need to find product market fit at the early stage. And, you don't always do that by asking people, hey, you have this problem, how should I solve it, right?
Exactly.
The best founders sort of almost first principles think it or have such a deep understanding of it. The second is that I'm looking for someone who has a sense of hustle and a sense of urgency and a sense of scrappiness about it. They're not afraid, if they're technical, for example, to learn about all the things it takes to build a business. How to do pricing, how to do packaging, how to think about marketing, how to get the word out. These are painful things, right? They're not sexy. Building and selling software has a lot of really tough and tedious moments. And so I'm looking for that scrappiness and that drive.
Does their previous experience matter that much? Like, have they found, like, do you look for people that have tried to found companies before? Do you treat them differently if they're a first-time founder?
I think there's pros and cons to both. First-time founders, they're almost like fearless and take a really fresh view and almost, don't dismiss things too quickly. And so I love that. At the same time, experienced founders, they've learned a lot of lessons, right? Whether they succeeded or failed, and they're extremely thoughtful, right? And they oftentimes have an existing network to draw upon. So,
are thoughtful about why they failed, or what do you mean?
Yeah, they're thoughtful about maybe the lessons learned from their prior experience. They're thoughtful about maybe their own strengths and weaknesses. Is probably the most. You asked me like, what would I look for people? Like people who can self-introspect, people who are self-aware about what they are really good at and what are the things that they need to put people around. Because ultimately, we talk a lot about founders in venture capital, but very quickly it goes beyond the founders. If things start to move, right, it becomes the team. And I've been part of those teams, right? I've actually not been a founder, but I've been part of those early teams. And so you need a founder that recognizes like, hey, I need a set of people that complement me.
Yeah.
I was listening to a podcast this morning to prep. It was it's called the Knowledge Podcast, and he had a guest on named Kunal Shah, who's a famous, well, he's a big VC in India. Specifically, he invests in India companies that sell to the Indian market. He said he's done like 200 plus seed rounds, and he's founded a couple companies himself. And he said he's got a couple tricks when he talks with founders and he's thinking about investing in them. One is he asked them to give his English is perfect, but he'll say, "My English isn't so good. Can you talk to me in Hindi?" And he said that if people really understand like what they're trying to tell people, then they can switch languages, and it's not a problem. But if all they've done is like practice the pitch over and over again, and they've given the pitch in English like 100 times or whatever, then they can't switch languages and tell the story in another language, even though they're fluent in the other language.
Yeah.
So that's like one trick that he uses. And the other trick that he uses is, well, I don't know if it's a trick, but he'll say, "Listen, tell me how I would describe your company in just a few words. Like, what do you do? But I want to talk to my friends at the dinner table who aren't technical using no jargon. So like, explain your company without using any jargon to me and why that's going to be a huge company."
Yeah.
And I think it would be fairly easy to do that maybe for something like Grafana, right? It's like, it's about seeing how systems perform and things like that, and getting visibility into how your website's doing or whatever. But some of the other ones, I was struggling to think like, how would I explain Hasura or something like that to non-technical people without using any jargon? Like, you can't use GraphQL, you can't use API, you can't use anyway. Yeah. So do you use any tricks like that, or have any like things like that you like to do?
No, I don't. I feel like these little tricks and parlor tricks are, unfortunately, they have a lot of false positives. It feels like every company and every situation is a little bit different. I do have things that, so one thing you mentioned, like storytelling, is a really big part of what I'm looking for. Like, if I can find a founder that tells the story and sort of similar to what you were saying, being able to describe something really simply, describe it to different audiences, that means the founder he's tried to talk about what he's excited about. And it's probably, some people got it and some people didn't. So he's tried 100 different ways to describe and tell his story about why he's building what he's building and what problems it solves. And so I'm listening very carefully to how that founder tells that story, but I'm not sure if it's like a trick that I use, or I'm trying to like, it's not a gotcha thing at all, right?
Not a gotcha thing, but like, would you be explicit about it? Would you be like, tell me the story like I'm your mom, tell me the story like I'm a high school kid, tell me the story like I'm, how would you talk differently to different people? Do you have them to do that? Maybe not so explicitly, but I don't know. How are you trying to get them to talk on different levels?
Yeah. I mean, I always ask them about their origin story, and I always ask about like what motivated them to do this and to build this. And honestly, some people can't really answer the question, right? Or hadn't even thought about it. So for me, investing in a company is more than just finding a right person and right technology. I mean, ultimately, as an investor, you're tied to this company and this person or people for 5 years, 10 years, even longer, right? You're potentially sitting on the board, and it's almost like getting into a marriage. And so, I think
some people are married for less time.
Yeah. I do feel like I'm married to some of my founders. Like, we even bicker and argue, and I think it's really important that you can be vulnerable. I think the best relationships are where people are vulnerable with each other. Yeah. They can be honest. They can talk about their personal lives. They can just be real rather than always have a facade of like, what does the VC want to hear? Yeah. And what does the founder on the other side want to hear from the VC? And so oftentimes first meetings are pitches where there's a presentation and, stories told. Assuming there's some alignment there, I quickly try to transition to like, is this like a person that I could work with? Can I be vulnerable with them and vice versa? I know that is not quite what you're asking, Chad. It's not a trick, but like for me, it says a lot about the person when I hear about how they talk about themselves.
I look for the same thing when I'm hiring. Like, I want people that are comfortable being in that space of vulnerability and like know themselves fairly well.
When you say vulnerability, are you really meaning like authentic?
Yeah, like you could call it a few different things, and I think there's probably a spectrum of things within that vulnerability space, and at least in my mind. One of the things that frustrates me is when people are always acting like someone else. They're acting like the person that they think you want to see.
Right.
And I've gotten better over my career and lifetime of just recognizing that. I think part of it is because I recognized the actor in me early on and have done a lot of work to try and see through that and let go of that illusion. And the more work I do on myself that way, I'm able to see it in other people, I think. So I don't know how else to explain it other than that. Like, people that are comfortable admitting that they don't know something are probably not going to hide lack of results when, they're running a team at your company. You know what I mean? Like, I've seen people hide things, hide failures, and only put the successes forward because they themselves are not comfortable being vulnerable. And that can be very poisonous in a company. And if you don't catch it early, it can ruin culture, honestly. So, like, I tie it all the way back to that. I mean, I think vulnerability is one of the most important things when you're looking for people, no matter what.
I can invest in a great, a set of founders and, cool idea and a great initial product. The reality is there's a lot of those funded that just end up going nowhere, right?
Yeah.
The actual process of building a company over 5 or 10 or 15 years is just a series of super important decisions that are made every single day, right? Strategic decisions, product decisions, go-to-market decisions. And so, ultimately, I mean, one, you could bring on an investor to provide some money and you don't listen to your investor, but like the whole reason I'm doing the job is that I find fulfillment in working with these companies. And so you need to be able to build a trust with those people building the companies, that they trust you to give them real feedback. And the only way to build that trust, right, is to have a deeper sense of a relationship versus just being a money provider. By the way, I don't think it's a necessity for the company to be successful, but it is a necessity for me to be happy in what I'm doing as part of the job, right? And that someone would trust me enough to say, hey, I have this really important decision. How do I handle it? A great example of this, Steve, is from Grafana, when we were deciding on how and if to partner with Amazon in the early days. Right. And, all the existential questions that come up, like, do you trust the CEO over at Grafana Labs? It's like, do you trust your investor? And, seek their guidance and, have these honest conversations about what are the pros and cons of doing that kind of partnership.
Yeah, it's a good example. So, Gaurav, let's talk about due diligence first a little bit. And this is a question about, like, not only how you do it, but do you have a team of people that help you do due diligence? And what are some of the key things you look for when you're doing your due diligence?
So it's different at different stages of a company. But I'll start with seed because I feel like all the things from seed still apply to later stages. With seed, you honestly sometimes have just like a PowerPoint deck, right? And maybe you have a prototype, and all of the diligence is on the founders. So it's spending a lot of time with them. A big part of it is doing back channel references. So these are talking to people that know those people and trying to uncover as much as about those people as you can to understand whether they meet like a lot of the criteria we look at that make great founders. And I mentioned a few of them before. That's a big part of it, no matter the stage.
When you say you're spending a lot of time with them, I mean, outside of the back channel stuff, but when you're actually spending time with the founder, in what context? Is it like a social setting and you're trying to see like how they are around other people? Are you spending time in their leadership meetings and seeing what they're thinking about from roadmap? Like, what are you doing there?
Good question. Sometimes it's just coffee meetings or Zoom meetings, going to, deep diving on a particular area like product, asking them a lot of questions, having a back and forth dialogue about strategy. So it's really about the company and getting more insight into the thoughts. Sometimes it's a meeting about getting to them know personally. So going for a drink, going for a meal, doing a dinner. We oftentimes do dinners because it lets people sort of let loose and be more open about who they are and their thoughts. It really runs the gamut. Sometimes it's a whiteboard session, right? We'll go meet at someone's office and say, like, let's map out the world together. Like, what does this company look like, right? And like, it's almost like practice for working together one day. What would a board meeting look like one day if we're debating some issue?
So you're almost thinking about it more like being a co-founder, kind of, at that stage.
Well, I think that's tricky to say because I think it's dangerous you are practicing what the interaction dynamic will be once you invest. But I think it's dangerous to think of that as a co-founder sometimes, because if you're not involved in the company on a day-to-day basis, advice is cheap. I mean, often advice can be misguided if you're not in the details. So I think both parties are evaluating, like, okay, is our interaction dynamic helpful or hurtful? Like, I always tell founders, yes, I was a product guy for 10 years. But the one thing I know is that I shouldn't be giving advice about product to people, right? Like if I'm not building the product, I'm not deep in it. If I'm once in a while, every couple of weeks, like taking a look at it, like I shouldn't be telling you where a button should sit or what an interaction flow should sit. So I'm hyper aware of that, but I'd say not all investors are, and but there's a little bit of like, okay, how are we going to interact? Is this productive? That's the people piece. Once there's a product, once there's customers, or maybe there's design partners and all that, is what we typically see at Series A. There, the diligence expands beyond the people to really like digging, I'd say, into the markets and the technology even more. And so, oftentimes we're talking to the company's customers or design partners to understand their experiences. We're talking to competitive customers that use competitive products. We're talking to industry experts. So like if I'm looking at something in observability, Steve, I might call you up and say, hey, what do you think? Or Chad, if I'm looking at something in NoSQL, I would call you up. Different firms have different models in terms of how they go about doing this. I generally will try to source as many of those customers and contacts either through the company or by my own network, or sometimes I go into like a Slack group and look at like who's using an open source project and just sort of ping them. And sometimes there's even services that are sort of like GLG type services where you can even pay a fee and like talk to customers that fit a certain profile. So venture firms use all those methods to reach these people. At the growth stage where you have companies with like significant revenue, call it 5 million, 10 million ARR plus, there you have a lot more to draw upon. There are a lot more customers you can talk to. And so, a lot of these services become more useful. At the Series A stage, I tend to do a lot of my own work, and then I leverage my partners for help. So oftentimes I will be setting up calls, but I'll also ping my partners and say, hey, who else do you know in the space? Who could we talk to? And then usually two of us will do these calls, right, together. And that's what we call the deal team. And that's really so that because we bring different perspectives, and so we tend to ask different questions, but also to gut check each other on like, how you could like ask someone a question and you hear what you want to hear, right? So I might ask a question of like, what do you think of this product? And one person might hear something slightly negative in the way they said it, and the other person might say they loved it. It's a good exercise to have two people in the room when doing these calls to really dissect what is the customer actually saying.
Do you have any examples of things that you saw either at the seed or the A stage where it was just like a red flag to you and you decided, no, I'm not going to do this? I mean, without naming names or anything, but just like...
Oh, yeah, all the time. This happens at the seed and at the A. Oftentimes the company will present their technical, idea, their product idea, and then they'll have a slide with a bunch of logos and say, we are in design partnerships and discussions with all of these users. And I'll say, hey, who's the person you're talking to at that company or that company or that company? Like, and I'll either try to reach out or get an introduction. And I'll talk to those people and they'll be like, yeah, I had one meeting with this startup. Yep. I don't think we're going to really use it.
They're overselling. Okay.
Like, right? Like clearly it was not like represented accurately. So this does happen quite a bit.
So don't oversell it.
Do not oversell with a VC.
Yeah, that's good. I mean, well, certainly. I mean, it probably does get through. I mean, there probably are VCs who maybe do less due diligence.
In 2021, I mean, some of these companies would start raising and they would have term sheets in 2 or 3 days.
Right.
And if you think about the time that it takes to like identify a person to talk to set up a call, even in our Zoom world, it takes longer than that, right? And it even takes longer than a week because, people are busy, they're traveling, they're doing their thing. So I don't understand how people did diligence.
Well, I think they didn't. They probably didn't, right?
I don't think they did. There's some well-known growth stage firms that put a lot of money to work. And from what I heard, in some cases, they did, after one meeting, half an hour meeting, they were ready to give a term sheet. And so
Wow.
what they were doing there,
It's like something out of Silicon Valley TV show.
yeah, they were doing what we call in the venture business like drafting off of signal value. What they would say is like, who else is looking at the deal, or who else has invested in maybe the earlier round? We trust that they've already done the work. We're going to sort of basically draft off of their work and be competitively advantaged by moving so quickly, quicker than anyone else, and giving an offer. And, of course, if you're an entrepreneur on the other side and you're desperate to raise the money and you want to just get it done with, like, no founder really likes fundraising. It's very rare. It's very painful.
Oh, they're just trying to build product. Yeah.
You're just trying to build product, and it's like you just want to get it done.
Well, this is how Theranos got so big, right?
Yeah. Well, as Theranos, with Theranos is a great example of this, right? You looked at all the amazing investors and people around, you're like, well, they must not be making a mistake.
That's right.
Yeah.
Former secretaries of state and such.
Now that is to your advantage. Like, if you raise from Lightspeed and you raise from a good investor that knows your space, the follow-on investors look at that and say, well, he knows his stuff. Like, this is probably a good company.
So once you like the founder, you like the tech and all that, how do you decide, and you've done the due diligence, how do you decide how much to put in? And I ask because, like, when I left MongoDB, I don't remember the details, but we had done either a Series E or a Series F, and it was a couple $100 million. We hadn't IPO'd yet. And I went to another pre-IPO company that was much smaller, and they did a Series A that was like $8 million, and this was in 2015. And now we're seeing Series A's that are like 30 to 60 million, and the Series B's are triple-digit millions, right? So it got bigger fast. Is it gonna go back to how it was 5 years ago, and we'll see more like $8 to $12 million Series A? You think it's gonna normalize where it was last year? What do you think is gonna happen?
I'll start with like how much to raise. Typically, we'll ask the founder, how much do you want to raise? And sometimes we'll work with them on figuring that out. But really, like we ask them to put together a 2 to 3 year plan. Sometimes they want to raise more than 2 or 3 years. They want to raise 4 years worth of money. But really, like, hey, what's your plan? How many people are you going to hire? How much do you need to build this product? What does that look like in terms of cash burn and some reasonable expectations of revenue? And you raise that much. If you want to grow faster and sell faster, you need to raise more, right? In a particular plan, because you're just going to burn more. And so that's what probably led to these mega-sized, Series A and Series B rounds, simply because like everyone felt like they needed to grow faster to compete. I would say I'm already seeing round sizes decline in this sort of newer market as compared to 2021 at the Series A and the Series B. So while there are downsides to raising too much, if you sit and the founder's side of things, like the one thing that you need to make sure of in your company is that you have money to pay payroll and to fund the company. The moment that goes away or that's at risk, like everything else is off the table. So it is the one most important thing. And so I don't think it's a mistake for founders to raise more than they need, right? And these mega rounds that happened in 2020 was exactly that, 2021, right?
Because they can always pare back and make it last longer as long as
right.
they have the money, yeah.
That's right. You could, effectively, you raise all this money, you put it in a bunch of CDs, right? And, it just sits there. You don't have to use it. Now, there is a downside to raising too much, which is that it can sometimes create bad behavior. Now, not all founders behave badly, but some could. And what I mean by bad behavior is it means you spend that money recklessly. And so, like, for example, like maybe you have a product market fit problem, but you don't realize that, and you go and you spend money on billboards on 101, thinking that like maybe my product will get adopted if I buy a billboard on a highway. And we all know that's a huge waste of money, or a Super Bowl ad, right? And so when you have too much money, you tend to be more reckless with it. There is also a slight downside to when you've raised too much, the expectations for the next round are even higher, right? You somehow, you've raised $100 million, and someone expects you then to be at a certain level of revenue or progress. And certainly it raises the bar for the valuation that the next person will invest in, or the valuation that someone might acquire. So there is that downside as well. But generally, you do want to raise as much as the market will allow, given a certain level of dilution. And that's exactly what happened in 21. The market's just not allowing that nearly as much as it was before, right? So
are you seeing any down rounds or flat rounds yet, or is it still too early in the sort of collapse here?
We don't really know whether this. So one, it's clear that market multiples have kind of compressed and maybe gone to what they should be, more normal. That has meant that a lot of the rounds were done with the expectation that things could be worth $100 billion, or now like, wait a sec, those clean companies are worth, a lot less, like half as much.
The comps are all lower too.
Yeah. And so, companies that raised in that inflated environment have not fully grown into their valuations. If for some reason they did not raise enough, because maybe the founders were dilution sensitive, because the more you raise, the more you dilute yourself. They did not raise enough, and they have less than 12 months of cash. They're having to top off their rounds in some cases. So they're oftentimes raising at the same valuation or just a little bit higher versus, significantly higher. And so I'm seeing that a lot. These top off rounds saying, hey, I have less than 12 months of cash, but I haven't really made progress to grow into my valuation. I'm going to extend my prior round a little bit to give me more runway.
Are they just looking for another 12 months, or it's not like they're looking 3 years out or what?
Yeah, sometimes they're looking for like another year because, the best practice is to have at least 2 years of runway. And so then they say, well, I don't want to dilute too much of my old valuation, but I want to have 24 months, and then maybe I'll go out in another year. Maybe the market will be better. But nobody knows. The reality is nobody knows what's going to happen. Think back to when COVID happened in March of 2020. Actually, the entire VC world predicted that like they're like, tighten up, like the world's about to come to an end, save your cash, and in fact it was this like massive period of productivity, right? So we don't really know. There's so many macroeconomic forces at play here. At this very moment, it's very hard to know how to price anything. And that has, at least for me, led to a slowdown in the investing market because we just don't even know how to price something. We're waiting to see whether this will be a long-term recession or this is just sort of a shorter blip due to inflation and supply-side factors and a few other things, Ukraine war, et cetera.
So Gaurav, one of the things I wanted to ask you about is like, valuations are valuations. We, at Grafana, we raised some money. Other companies raised money, and they raised it last year in that environment, and now it's this environment. So is it just a matter of growing into the valuation and then growing beyond? Or is there ever a case where you like revalue or remark companies? Does that ever happen? Or does it happen if they need to do another round and that's where down round comes in or flat round comes in?
Most of the time, we don't try to revalue companies that have been valued at a particular valuation due to a funding round because, like, then we're like constantly, the market goes up, we change it to one valuation, the market goes down, and we change it to another valuation. It was just a lot of flip-flopping, right? Yeah. Without any sort of objective way of evaluating these things. So we typically wait for the next round to sort of assess where the company is at. Now, there are situations where, a company raised at a really high valuation and they completely miss their numbers. It's very clear that things are not working. And there are cases where a company will either through the 409A process revalue itself, right? Or, VCs themselves will sort of carry the company at a lower valuation. But I would say it's rare.
Chad, I wanted to go into like some of the diversity topics just to get Gaurav's perspective on that. All right. So Gaurav, how does Lightspeed think about diversity in founders, diversity in partners? And like, do you actively talk about it, or is it just something that you kind of have in the back of your mind as a guiding principle, but it's not really a focus? You're just trying to find great companies and great founders to invest in.
We're actively talking about it all the time. If you have a fundamental thesis that a diverse set of ideas in a company makes for a better company, and also that great companies and great ideas come from everywhere, right? And all populations, then you have to design around that. It's also just not about making money for many of us, right? Yeah. It's also about like building great places for people to work at, like doing good for society. I think diversity plays into making money, but it also plays into those other things. We do have a belief at Lightspeed that diverse investor groups end up funding diverse sets of companies, right? And so, for example, we have a scout program. Not everybody knows what a venture capital scout is. So, a venture capital scout is basically someone who has a full-time job, maybe as a salesperson or product manager, usually at a tech company, and is identified by the VC firm as being a good person who has a great network and is on the ground and that wants to learn how to invest. Now, that person may not have enough money to do their own angel investing. And so what the venture capital firm does is give them money to invest on their behalf, right? And in return, that scout can build an investment track record, which may ultimately lead to them becoming a venture capital investor, starting their own fund, or maybe they're just doing it for fun. That scout program that we have at Lightspeed is dedicated to sort of underrepresented groups, right? And so what we found, and that program wasn't always like that. Originally it was sort of like the friends of the partners and the people we know were scouts, and then we changed the program, and it was like incredible. Right, the kinds of companies that scout group is funding are very different from the ones that necessarily we see. Right, being being from different backgrounds, and so that's one way in the company building process. So once we've invested, we have our portfolio companies. This is a conversation we have with the executive team and the founders like all the time. Like, how do we make sure our executive team is diverse? How do we make sure the board is diverse? And as you know, it's sort of a self-fulfilling prophecy. Like, if you have, strong women executive leaders in your company, they're going to draw more, right? So, it's also very important to us.
All right, so switching gears a little bit, Gaurav, when you invest in a company, sometimes when VCs invest in a company, they get a board seat, and sometimes they don't. What is it that it's just a function of like, well, you're investing this much money, you get a board seat, you invest less than that, you don't, or is it more complex than that?
Part of the term sheet and deal negotiation process is a decision of whether the investor is going to take a board seat. So at the seed stage, the company's usually too early to have a board, right? There's what would the board discuss, and usually there's only a single investor, right, that might have a large enough stake to really matter. And so, typically you don't see board seats at the seed stage. At the Series A stage, the lead investor will typically take a board seat, but it's always negotiable. There's some rules of thumb, I would say broadly, but if you're the lead investor and, you own, a certain number, I'll throw a number out there, like more than 10% of the company, right, that may justify a board seat.
Why wouldn't you take a board seat if you were the main investor in a Series A?
One, you end up spending a lot of time with the company, right? You got to go to the board meetings. You gotta, there's an obligation, there's a liability, right? There's
let me ask this. So you're going to lead the investment. Let's say you Gaurav personally are going to be the general partner of the investment. But could Lightspeed get a board seat, and just someone else at Lightspeed takes that board seat, not you?
So the way this works, I think in 99.9% of the cases, actually the VC firm gets a right to a board seat. And then they nominate a partner to that board seat. So in the case of Grafana, Lightspeed has a board seat, and they've not even nominated me. However, like for example, if I leave Lightspeed, for some reason, right, they could nominate somebody else. So that's typically because Lightspeed is making the investment. In my case, I always try to take board seats because I'm always investing in people that I really want to spend time with and want to be involved if the company wants me to. But sometimes the company doesn't want someone to take a board seat. Like so for example, I don't have a board seat at Clickhouse. I'm what's called a board observer. I didn't make a large enough investment to justify the board seat. Aaron already has a great board. You sometimes want to keep your board small, otherwise it becomes a room with too many opinions. The other reason investors may not want to take a board seat is that it does take time to sit on boards. And so if you're the kind of investor that is already on a lot of boards, you're in a lot of meetings already, you can't, you're spreading yourself too thin. And so you may want to make the investment, but you tell the founder, like, I don't need to be on the board, or, and sometimes that's oftentimes how it plays out.
I wanted to bring up one news article here that I read yesterday. Basically, Facebook, Meta announced that they're bracing for a deep economic downturn, and they reduced its target for hiring engineers this year, 2022, to around, they dropped it by 30%. Basically, they cut their hiring forecast by 30%. That's the first time I've seen a big company like this that's basically making such a big cut in their own growth plans. I mean, we've heard about it with startups and Coinbase retracting offers and things like that, but for such a big company, that was a little like, whoa, it's affecting really big companies now too. I don't know if you're seeing that at other big companies too, or
there's some early signs like that people's businesses are going to be compressed. I think Meta's a complicated beast, right? With a monetization model and a growth model that has some challenges right now, and so they're probably predicting something. The interesting thing is that's going to have ripple effects. Meta is also a big buyer of software, right? And so the question for all of us, especially in enterprise software, is like, how are those ripple effects going to affect our own companies? So I worry about it. I do worry about it all the time. We're monitoring it super closely at all of our companies. All this given, right? It's a tremendous time to start a company
because it's going to be easier to hire people because the IPO market's soft and all that.
Hiring could become easier, but there is so much money raised in the venture capital business in the last 2 years that there is a ton of money looking for people to fund.
Oh, that hasn't been invested yet. Uninvested.
Yeah, that hasn't been invested yet. And so...
How much? Do we know how much? Like, is just sitting out there on the sidelines in open funds? I don't know if that's something that gets reported on or...
I thought I saw this earlier this week. It was like, I think high billions of dollars still left to be...
tens of billions easily. I mean, hundreds of billions, who knows?
Wow.
Yeah.
Well, anybody who needs money, Gaurav's got it. So come talk to him. He's your man.
Yeah,
you heard it here first. All right. Hey, Gaurav, thanks for joining us today. We usually, when we're doing these episodes, I'm like making mental notes about conversational threads that kind of didn't go anywhere or didn't, that I'm probably going to edit out later, but I didn't have any of those today. We're happy to have Gaurav here as our first ever VC. If you like this episode, please share it on LinkedIn, and so people can get the word out and help us spread the viewership. We really appreciate it. Thanks, Gaurav, for joining. We appreciate your time.
Thanks, Gaurav.
Take care, guys.